In 2021, millions of everyday people bought a single stock at its absolute peak, not because the company was profitable, not because analysts told them to. They bought it because everyone else was buying it, and within weeks, they lost nearly everything. That stock was GameStop. And the real story isn't about Wall Street or short sellers. It's about something happening inside your own brain right now, every single time you think about money. There are invisible psychological traps wired into your mind that make you a worse investor without you even realizing it. And by the end of this video, you'll know exactly what they are and how to fight back. Here's the uncomfortable truth. Your brain was not built for investing. It was built for survival. Thousands of years ago, following the crowd kept you alive. If everyone ran from a bush, you ran too. No questions asked. That instinct saved your ancestors. But in the stock market, that same instinct can destroy your savings in a single afternoon. This is called herd mentality. And it's just one of at least a dozen cognitive biases that mess with investor decisions every single day. A cognitive bias is basically a mental shortcut your brain uses to make fast decisions, usually harmless. But when real money is involved, these shortcuts become very expensive habits. Let's walk through the big ones. Imagine you're shopping for a jacket. You see it was originally priced at $500, now marked down to $300. Feels like a deal, right? But what if that jacket was never actually worth $500 in the first place? This is called anchoring bias. Your brain latches onto the first number it sees and uses it as a reference point for everything after. Investors do this constantly. They say things like, "This stock used to be at $200, so at $80 it must be cheap." But a falling price is not automatically a bargain. The original number means nothing if the company's fundamentals have completely changed. Anchoring makes you chase ghosts of prices past. Now here's one that hits even harder. Think about the last time you researched something you already believed in. Did you look for reasons you might be wrong? Probably not. Most of us search for evidence that confirms what we already think. That's confirmation bias. An investor who loves a particular tech company will read every bullish article, follow every optimistic analyst, and quietly ignore the red flags sitting right in front of them. This bias is turbocharged by social media and financial news. Algorithms feed you more of what you already agree with, so your conviction grows. But your actual information stays dangerously narrow. You feel more confident, but you're actually becoming less informed. Speaking of feeling confident, let's talk about what happens after you make money on a trade. You probably tell yourself, "I saw that coming. I did my research. I'm good at this." And when you lose money, the market was manipulated. Nobody could have predicted that. Sound familiar? This is the self-attribution bias. Wins are your skill. Losses are bad luck. And it quietly inflates your ego to dangerous levels. Over time, you start taking bigger risks because you believe you have an edge you don't actually have. The market has a brutal way of correcting overconfidence, and by the time it does, the damage is already done. Here's the one that probably costs everyday investors the most money of all. Imagine you have two investments. One is up by $500. One is down by $500. Mathematically, they cancel out. But psychologically, that loss feels roughly twice as painful as the gain feels good. This is called loss aversion, and it was proven by Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky. Because of loss aversion, investors hold on to losing stocks way too long. They can't stomach the idea of making the loss real by selling. They keep hoping it comes back. Meanwhile, they sell their winning stocks too early because they want to lock in that good feeling before it disappears. It's completely backwards. And it bleeds portfolios dry. Remember GameStop from the beginning? Let's go back there for a second, because what happened wasn't just herd mentality. It was something called the availability heuristic at work. When people constantly see a stock mentioned in headlines, Twitter feeds, and group chats, their brain starts to believe it must be important, valuable, and safe. The more available a piece of information is in your memory, the more real and significant it feels, not because it's actually more important, but because it's louder. This is why meme stocks spike. This is why people pile into sectors after they already peaked. The noise gets mistaken for signal, and by the time the noise stops, the damage is done. Now let's talk about a trap that stops people from even starting. The status quo bias. Your brain treats doing nothing as the safe option. If you have money sitting in a savings account earning 1% interest while inflation runs at 3%, you are actively losing purchasing power. But because you didn't do anything, it doesn't feel like a loss. Inaction is still a decision, a financially damaging one. Status quo bias makes people delay investing for years. They say they'll start when the market calms down, when they have more money, when they understand it better. But time in the market beats timing the market. Every year you wait is compounding, working against you instead of for you. So how do you actually fight all of this? First, write down your investment thesis before you buy anything. Why are you buying this? What would have to change for you to sell? This combats anchoring and confirmation bias because you're committing your reasoning to paper before emotions take over. Second, force yourself to read the bear case. Whatever you want to buy, find the strongest argument against it. Third, automate what you can. Set up automatic investments on a schedule. Remove your emotions from the equation entirely. And fourth, track your decisions, not just your returns. Write down why you made each move. Over time, you'll start to see your own patterns. That's when real improvement begins. Your brain is not your enemy. It's just running very old software on a very new problem. The investors who win long-term aren't the ones with the highest IQ or the best stock picks. They're the ones who understand their own weaknesses and build systems to work around them. Awareness alone puts you ahead of 90% of people who invest on pure emotion and gut instinct. You now know about anchoring, confirmation bias, self-attribution, loss aversion, herd mentality, the availability heuristic, and status quo bias. That's real knowledge. Use it. If this opened your eyes a little, there's a whole library of videos on this channel diving deeper into each of these topics one by one. Start with whichever bias you recognized most in yourself. That's the one worth understanding first.